Okay.
Yes.
Somebody have a question?
Sorry, I have a question.
Yes.
All right, so now this, because when you were showing us the slides before, like there was a part where you said that you cannot recognize profit until the end of the contract, until you've completed the contract. So this example, which one in particular is this?
I cannot complete a contract.
No, you told us that like there was one we did, I think, is it percentage of completion, where you said you do not recognize profit until the end of the contract, until you've completed everything. That's when you recognize your profits. But I saw that here you recognize the profits in each year.
Yeah. So in this question, for the year 2018, you recognize the $6 profit, right?
Okay.
So
which method is this?
it's the same method.
The cost to cost.
The cost of cost is to calculate the percentage.
Yeah.
When you are talking about the cost to cost approach, that's when we use it to calculate the percentage of completion. So that's the cost to cost, the two cost numbers.
So confusing to me.
You know, Professor, the reason she confused, even I was looking textbook like, 10 minutes ago, like long-term contract and cost to cost. Like when the textbook calculated like the long-term contract, the way you did, and then the textbook is a little bit confusing. I was like looking to before like 10 minutes ago.
Okay, how come it's confusing?
Page 170.
Page, you are talking about textbook page, just give me 1 second. Page 170.
Yeah.
So if you don't have this question, you are comfortable with this question, you can take a break, okay? I'm going to just talk to Baruch about page 170, right?
Yes.
Okay. Yeah, go ahead.
Yeah, when you back to page 169, the long-term contract, yeah,
yeah, so
yeah, the long-term contract, the way you does, and then the textbook is a little bit like, it's even me too, like little bit confused. Right?
Yeah, that's
like,
why I said, well, don't, the tables they are using, I don't like it. That's why
yeah.
I'm saying you should maybe, I was thinking, how can I help you better understand? So that's why I came up with these pictures, right?
Yeah, I think yours is much better, yeah.
Okay, but you are still confused with my approach, or
the textbook, when you look at the textbook, is like, to match your calculation, and then it's like,
yeah, I know there are too many things there, and it's much easier if you do this way, right? You see the picture, right? You know where you are, right? Which time point you're talking about.
Yeah,
and then
that's right.
Based on this picture, you do this calculation. It makes more sense rather than looking at these tables. What happened is when you look at these tables, you see all these numbers at the same time. So you are confused about the time point. That's why I think you should look at this picture. So okay, here, I'm at the end of the 2018, right? And so then how you going to do, which is the estimate, right? How you going to do the percentage?
Yeah, this one is fine. Can you go back to the long-term contract, please?
The long-term contract?
Yeah.
The previous slides, right?
Yeah. The last one, the one you, no, the last one, the one you got at the last, like, the long-term contract. Example now, we had it the last example, right?
This one, or is this the right one?
No.
Oh, the last
before break.
Okay.
Yeah.
Okay.
Yes.
This one. Yeah.
Yeah. So the one you got 2,000,005. Yeah, this is the one. So in textbook, 2017 and 2018 cumulative cost. 2017 is and then 2018 2 million and then 5.5. In textbook, when you do cumulative cost, it's okay. I got it. It's fine. That's okay.
Yeah. So I think
That's okay.
I
I'm not gonna
understand
do
your
the textbook.
concern.
I think yours is much better. I got it.
Okay. We can do a different way. We can do it a different way. So maybe I will make this homework for you guys to do it differently. If you are more comfortable with this way, just do this way, okay?
I think no. I think yours is much better for me.
Okay. Are you okay now?
Yeah. I'm okay. Thank you.
No problem.
Excuse me.
Yes.
I think where my confusion is coming from is in one of the slides, you said we have two different methods for estimating the contract. You said the first one is cost plus, right?
Mm-hmm.
Could you go back to the slide, please? Because I think I know where I think 48.
This is the cost plus.
No, the 48, slide 48.
Slide 48 here, yeah.
Exactly. All right, so, okay, fixed price contract and the cost plus contract. So just now we did cost to cost. Where does it fall under these two different types of contracts?
I only used the one slide talking about cost plus contracts, right? Everything else, I'm talking about a fixed price contract. So remember I mentioned, I'm only using one slide, 2 minutes, to talk about the cost plus contract. I'm going to use the rest of the class lecture to talk about the fixed price contract.
Okay.
Yeah. So when we talk about the cost to cost approach, okay, it's under the umbrella of the fixed price contract.
Fixed price. Okay.
Because cost plus contract, it's very easy, right? I showed you, this is how you do it. You don't have to estimate the percentage of completion.
Okay.
The method we are using, the cost to cost approach, this method is to estimate percentage completion.
Okay.
Yeah. So you confuse with cost to cost approach versus cost plus contract.
Yes.
Okay.
Yes. I think that's where the error is.
Okay.
So one more question before, sorry, I'm just, the last question that I have is, you mentioned something about not recognizing profit until the, like if you are estimating, I really can't remember how you said it, but you said you should not recognize profit until the contract is complete.
No, we are, for the long-term contract, it's you recognize revenue over time, right? If the contract is a 5 years contract, long-term contract, if that fits the 3 criteria, you can recognize over time. So every year you can recognize a portion of the revenue.
Okay, so please go to slide 49 now.
Slide 49. Yeah.
Yes.
Mm-hmm.
Okay. Just give me one moment, please. I want to be sure I have. All right, so here also you recognize profits, right?
Mm-hmm.
Okay. Thank you so much for clarifying that.
No problem. I think the 10 minutes is up. So I will just keep going. Are you guys all come back?
Yep.
Yes.
Okay, we'll keep going. Okay, so what time is it? So we are going to talk about accounting cycles for construction contracts, okay? So let's talk about construction contract is the typical long-term contract, right? What is the accounting cycle, okay? So I'm going to introduce the 5 distinct phases and what are the accounting journal entries like, okay? So the 5 distinct phases is first one, you incur cost on the client, and then you have to bill the client, right? You don't have enough cash. You cannot keep burning your own cash, right? The project is $10 million project. You don't have that much money. So over the process, you have to bill the client, right? Ask for their money. And then the client will pay you, right? You receive payment from the client. And then you also need to recognize revenues, right? Remember, that's all we are learning now, right? We want to learn how to recognize how much we're going to recognize the revenue. And then the last phrase is when upon the completion, you're going to close all the accounts, right? You're going to close all the accounts. So that's the 5 distinct phases for the construction contracts. Let's take a look at what's the journal entry look like. For incurring cost, what's the journal entry? Can anyone tell me? When you incur the cost, what do you debit? What do you credit?
Construction in progress would be one of them, wouldn't it?
Mm-hmm. Do you debit or credit?
I think you debit.
Okay. And the other side? What about the other side, credit side?
Cash, I guess, or AR.
Yeah,
Cash.
AP, cash or AP, yeah. Okay, so construction in progress, you debit construction in progress, you credit cash, right? The nature of the business of this construction contract is to create an asset, just like you make a furniture, like you make a whatever, make a good, right? And in 2400, you learned about it. For manufacturing industries, you have raw materials, right? You have working in progress, right? You have, right? So here we use an account called construction in progress, okay? So you debit construction in progress. This is the asset, right? This is the asset you are creating. You are creating this asset, right? So you debit this, and then the cost either is cash or is AP, right? Now, what's your journal entry for billing the client?
Debit, account receivable.
Okay, when I talk about the journal entry, you should let me know your debit or credit, right? If you
Debit account, debit account receivable.
Yeah, credit.
And then credit, work in progress something, or maybe account payable, I don't know.
Okay, yeah, you are right. You debit accounts receivable, right?
Yeah.
Do you credit sales?
The billing maybe on work in progress or
So why don't you credit sales? In 2100, almost every time when you debit AR, you credit sales. How come here we are not credit sales? Anyone? Do you know why we are not credit sales here?
Because you're not selling, you are constructing. So there is.
Because you can recognize the revenue at the end of the reporting period.
Yes, very good. So whenever you talk about the credit sales, that's a recognition of revenue, right? So that's step 4. We are not there yet, right? We are talking about the number 2. If you credit sales, that means you recognize sales revenue, right? We are not recognizing the revenue yet, okay? So what we do is we debit AR, we credit account called billings on construction in progress, okay? We credit this account called billings on construction in progress. Suppose the fixed price for this contract is 10 million, right? What do you think the balance of this account would be at the end of the project?
0.
0.
0? Okay, before they, okay, how should I say this? I got your point. Okay, I know why you say 0. So eventually, before you close this account, what is the total balance should be before you close it?
Your revenue, your total revenue.
10 million?
Yeah, 10 million, right? Because the fixed price is 10 million. So in total, you should bill 10 million, right? Right? Because the total price, agreed price is 10 million, and you are billing the client over time. But the total amount of the billing should be equal to 10 million, right? Number 3, when you receive payment, this is the easy part. You receive payment, you debit cash, credit AR, right? Debit cash, credit AR, right? Number 4, when you accrue revenue. So this is the time you're going to recognize revenue, okay? Recognize revenue and expenses. What is our journal entry?
Cost of
You're gonna debit the billing and construction process and the credit revenue.
Okay, credit revenue, debit what?
The
Sale.
billing and
Cost of
construction.
Debit the cost of sales. That's right. Because when you recognize sales, you also recognize cost of sales, right?
Yes.
Remember the matching principle? Okay. But there is another debit because cost of sales for profitable contract will be less than sales, right? So you need additional
construction, the
construction, right?
Yeah.
So your profit is all in that eyesight you are constructing, right?
Yes.
Okay, good. So you credit revenue, you debit the cost of sales, and you debit the construction in progress, right? You debit your construction in progress because all your profit is actually embedded in that eyesight you are building, right? You haven't realized it yet, but the minute you handed that building to the customer, they paid you all the money, you realize all the profit, right? Okay. So now my question is, so you debit here, you have 2 entries, right? Over the years, you debit construction in progress, credit cash AP. Here, you debit construction in progress. What is the total balance of the construction in progress at the end of the contract upon the completion?
Maybe debit, billing, construction.
10 billion, right? 10 million, yeah? Because that's how much it's worth, right? Remember, the fixed price is 10 million. So the asset you build worth 10 million. That's why the agreed fixed price is 10 million. So at the end of the day, the total debit balance for construction in progress should be 10 million, should be equal to the fixed price. Does this make sense?
Mm-hmm.
Because that's how much you think your asset worth, right? You are building an asset, right? And you're gonna sell it for 10 million, right? And so at the end of the day, the value of this asset is 10 million, right? Upon the completion. So the last phase is closing the accounts at the end of contract. So you're gonna close these 2 accounts. So this account, billings on construction in progress, is gonna be 10 million credit balance, and the construction in progress is gonna reach 10 million at the end. So because the contract is complete, you handed this asset to the customer, okay? You're gonna credit constructions in progress, and they do not owe you anymore, right? The billings should be cleared, right? So both will be closed. Both accounts will be closed. Any question?